Welcome to this overview of international business strategy, the simulation game. What we're going to do in this brief overview is give you an idea of the many decision-making screens that you will encounter as you proceed through the simulation. Depending upon your team structure, you may be in charge of products, you may be in charge of marketing, HR, finance, and so on. Basically, you will log into your system using the student login. Prior to that, you would create your account, you would pay for the license you use, but once that is completed, you would enter in using your login code that you've created, email address and password. It's important to remember password is case sensitive, so therefore you should save it in a secure location. Once you have logged into the system, you will come to what we call the main screen. Now, on the main screen is where you will proceed to go to the various decision areas that are your area of responsibility. You may be the marketing manager, you may be the product manager, you may be the product line manager, you may be HR, finance, whatever it has been decided by the team your functional position is. When you look at your main screen, there are a number of elements that are important. The first one, as you can see here, are the due dates of each of the yearly processing, the 4 years of the simulation itself. You need to have your decisions for your functional area completed by that specific time period. It's recommended that it be completed prior to it rather than closer to it. You also have the ability to go to student training and so on. The second part of your screen shows you team activity. This gives you an opportunity to assess the participation level of your team members, also the relative positions of those team members. Your position is designated under the Edit Profile feature, which we'll show you later on. But here, this gives you the last date that was logged in, the login, and the minutes. We then come to the current year economic parameters. These are parameters that have been either randomly created or set up by your faculty member. And what they are is a series of economic characteristics associated with international business and business strategy. You also will see here the countries that have been selected by your faculty member, the currency that has associated with each of those countries that you have, and the various economic parameters that range from exchange rates, PPP, tariffs, and so on. Once we're done looking at the current economic conditions, we now have two, if you will, analyses that take place. One of them is the growth analysis, which essentially shows each product's growth over the fiscal periods that have been played to date. And as you can see in our example here, we are currently in the first fiscal period. So it shows you the product information. In addition to that, the gap analysis shows you by team where the teams have concentrated their efforts, where they have been selling products, and so on. These two are the due diligence that normally are performed by the team to ascertain where there may be opportunities to expand business, where there may be opportunities to expand revenues. So once you log in, you're brought to this main screen. And this main screen is where, if you will, think of it as your dashboard, your control panel. This is where you will begin your fiscal decision-making process. Irrespective of the position that you're in, you should analyze all of the elements that are on this main screen so that you are prepared for the decisions that need to be made during the fiscal period. After you've analyzed the current state of the corporation, its position in the market in the various countries that it's selling its products, the next step is to look at the products and to ascertain, do they need to be redesigned? Do they need to be changed? Do we need to make adjustments to our export mode and so on? And for that, you would go to the product screen for the specific products. There are 4 products you could have in the simulation. And typically, you will have a manager for each product, or you may possibly have a product manager that manages all 4. Again, this is a team decision. But in all cases, effectively, the first element and component is to design the product or redesign the product. And when you redesign a product, you are basically looking at the features that the product is composed of and the value proposition each of those features has in the market that it is being sold into. The value proposition, as you can see from the screen, is a digit from 0 to 7, where 0 represents no value, 7 represents the maximum value. So the objective of each product manager, the objective of each product designer, the objective of each product is to ensure that it has the maximum value to the intended market that it is being sold to. To select product features, you would go ahead and select the checkbox. Once you've completed, the next step is to then determine the selling mode of the particular product in a country. Now, product screen 1 also controls the determination of the domestic and the FDI markets. Product screens 2, 3, and 4 only are enabled to determine export markets. So it is a team's decision to decide which countries will be domestic and which countries will be FDI. You can only have one country being domestic, one country being FDI. So what you would do is you would go in, you would create your product, you select the sell-through, and then you look at the results. In this case, you look at the results of product 1. You also can name the product for greater clarity, and so each product, product 1 through 4, would have a unique name to be identified by the company itself. So essentially, you are looking at designing a product based on the value of each of the features in that product, and you are determining the sell-through of that particular product. Noting again that the sell-through for domestic and FDI is determined in product 1 as opposed to product 2 and 3. So once you have completed this, analyze, ensure that your product that you have created is achieving the greatest possible value in the market that you have selected for it to be primarily sold into. And then you would then proceed to products 2, 3, and 4. Let's go ahead and take a look at product 2. Product 2 is very similar to product 1, except, as you will notice on the screen, it does not have the capability to determine domestic and FDI. Again, here you would select the features most appropriate for this particular product and the market that it is intended for. Again, you can name the product. You could select whether it will be exported into a country or not. But if you notice, the domestic and the FDI remain the same as for product 1. You can name the product again for clarity purposes. So essentially, product screens 2, 3, and 4 are identical to product screen 1, except you do not have the capability to determine domestic and FDI. That is only done on product screen 1. As with product 1, product 2, once it's been designed, the product manager would look at the overall effectiveness of that product, that is, looking at the features and how those features correspond to the targeted markets that the product will be sold to, and is it achieving the greatest possible value. We would have the same type of analysis for product 3. Come into product 3. You will notice again we have a similar screen. Here, the product manager for product 3 or the product manager would then determine the features for product number 3. You would go ahead and name the product accordingly. And again, you could select where this product would be exported into. You have a maximum of 2 countries that you can export into. In our example here, we have 2 countries that are the same, so therefore we only have 2 possible countries. You could also elect not to sell in a particular country, again, depending upon the value proposition, which is why each product manager or the product manager would look at the value proposition of the design product, product 1, 2, 3, or 4, and see how it is valued in each of the target markets that one is pursuing. If we look at product screen 4, we'll see it's going to be identical to product screens 2 and 3, and slightly different from product screen 1 in that it cannot designate in the first year the domestic and FDI. That is another important consideration. After year 1, you can change whether to sell into a market via export or not, but you cannot change domestic and FDI. That is constraint to first year decisions. As always, the product manager should look at the value of the product in the intended target country that is being sold to. Note, every product sells in the domestic market and the FDI market. So you have products 1, 2, 3, and 4. And the only difference in the decision screen in year 1 is that product 1 can also designate the domestic and the FDI countries. In year 2, 3, and 4, the product screens are exactly the same. Once we have designed the product or products, the next step is to then proceed to market these products. And similar to the decision screens we had for the 4 products, we have 4 decision screens for marketing. Similar decisions are going to be made in the marketing environment as we did in the product environment. The first set of decisions is to create an advertising campaign for the specific product. An advertising campaign is made up of 3 ad plans. Each ad plan has an effectiveness rating in the targeted country. And so as a result of that, it is important to understand the value proposition of the product in that country and then select the ad plan that's going to create the ad campaign that is going to be most effective in the country where the product has the highest possible value. Similar to the value proposition, the ad plan effectiveness is a rating from 0 to 7. 0 means no effectiveness whatsoever, no matter how much dollars are spent. 7 means extremely effective. So depending upon the value proposition of the product in the targeted country, the marketing manager needs to create the ad campaign that is going to effectively be the most effective in making the product aware, the customers aware of the product in that market. The second stage of decisions that are made are associated with promotion, which essentially makes the demographic aware of the product, and the selling price and the number of units, i.e. the forecast, the number of units that are going to be sold. Again, we need to look at this from the perspective of the value proposition of the product itself and the promotional effectiveness. In a market where we have extremely high value proposition, in a market where the ad campaign is extremely effective, we would then want to promote the product much more extensively. And this would give us the ability to make more individuals aware that our product exists. And that is the purpose of promotion, is to make the awareness of the product to the demographic itself. You then would proceed to enter in the budgetary amounts in the currency that is noted. The next step after entering and creating this budget, this promotional budget, is to determine the selling price. Now, the selling price is a little bit different. It shows you the recommended selling price in domestic dollars. Then the objective is to, based on the competition, based on the value proposition, based on the promotional budget, how much will you charge for this particular product? And so then you proceed to enter in the selling price in the targeted country or targeted market in the country. The third decision that needs to be made is how many units are you projecting will be sold in this particular market or country. And again, that depends upon the competition, the promotional aspect, the value proposition, the price. All of those play a role in the decision on how many units you will sell. Then, once you have made that determination, you then decide how many units to order. That is, how many units are you going to order to sell in a particular country. And once you're done, you update the information, and it now reflects those decisions for you. Marketing screens 2, 3, and 4 are identical, except they relate to products 2, 3, and 4 respectively. Let's go take a look at product number 2. And so we look at the marketing screen for product number 2. And what will happen is it looks exactly the same, except now you create an ad campaign that is supporting product number 2. And again, product number 2 may be sold in different markets. It may be specified to be dominant in one market versus another. So therefore, the ad campaign should be aligned to product number 2's strengths, the value proposition. The same thing would hold true in terms of the products 3 and the product 4 that we have. So once we update, we then come down and we have the same set of different decisions that we need to make. How much promotional budgets are we going to have? What is going to be the selling price? What is going to be the order quantity, i.e. the units we're going to be selling? So it's important to remember that in this particular example, we're dealing with product number 2. We're dealing with the value proposition of product number 2 in each of the countries. So we are creating an ad campaign that is unique to product number 2, a pricing structure that is unique to product number 2, and we are ordering the appropriate number of units to be sold in each of the targeted countries for product number 2. So the key is this process is then repeated for product number 3 and for product number 4. Identical screens. Again, the idea behind it is to create an advertising campaign that is most effective in the desired market/country, determine the promotional budgets, the selling price, and the quantity to order for sale in that particular product in that particular country. Now, it's important to remember, we'll talk about this a little bit later, we need to make sure we have inventory facilities to store excess inventory. Once we're done, we've completed that process, we then would go to the next one. Now, depending upon how your team is structured, you may have independent marketing managers, you may have a manager for product 1 and marketing of product 1, you may have a product manager with subordinates, you may have a marketing manager with subordinates. In cases of screens 1, 2, and 3, they are identical. As you can see here, we're now in the process of creating the advertising campaign for product number 3. It has then the same set of promotional budgets, pricing, and order quantities that we had in product marketing screens 2 and 1. And the same thing holds true when we go to product number 4. So marketing screens 1, 2, 3, and 4 are identical in terms of the decisions that need to be made. The goal is to create an advertising campaign unique to the product, and then a promotional budget, a pricing, regimen and a selling cycle that we would employ. While the product and marketing managers are performing their respective tasks, the corporation's HR manager is going to be looking to enhance and improve the human capital of the corporation, to hire more people, to expand the company, to train those individuals, to develop their loyalty to the corporation, and so on. This set of tasks are performed under the HR screen. As you will notice, the HR screen is only available for countries that are domestic and FDI defined. Export countries, the company has no corporate staff, no employees in that country. Effectively, it is representative. So the HR decisions are related strictly to the countries that have been designated as domestic or FDI. And the decisions that are going to be made in these respective countries are associated with recruitment of new employees, training of these employees, and development of corporate culture. Each of these has an impact also associated with the culture of the targeted country as well. So the HR manager, in making the HR decisions, needs to be aware of the cultural aspect, the cultural component associated with the particular targeted country where staff complement of resources is going to be built. And then proceed to enter in budgets associated with these various functional areas. A, recruitment, B, training, C, development of corporate loyalty. This will impact the salaries of the corporation. It will impact the marketing effectiveness of the corporation. It will impact the operational effectiveness of the corporation. So therefore, by hiring people, by training them, by developing a corporate culture, you'll be saving, in some cases, salary. You'll be enhancing revenues and marketing effectiveness. And you also will be, if you will, improving operational environments through efficiency of staff. So this is the responsibility of the HR department. And as stated, these decisions are only allowable in domestic and FDI countries. Export countries have manufacturers or sales representatives. They, however, are not employees of the corporation, and thus HR has no responsibility in countries that are being exported into, or obviously countries that no sales are being made. Once we're done, we update the information and we'll proceed to see what is the current expenditures and so on, and what is the projected increase in salaries, marketing, operations, effectiveness, and so on. These are mere projections. These are not guarantees. They are, if you will, estimates of what the benefit gains may be. They will be close to these values, but it's not absolute. It is not deterministic. There is some randomness associated with it. And don't forget the impact of culture. And as you'll see, culture is a plus or minus number that will impact these characteristics. To refresh your memory on the various aspects of the simulation, there are tooltips everywhere. You'll notice these tooltips have an asterisk next to them. In the case of the various economic parameters, just go back to your main screen, click on economic parameters, and up will appear a table which describes in detail these various characteristics. So when it comes to culture, as you can see, it states culture will impact the HR recruitment and affect the loyalty aspects of it. Anywhere you notice an asterisk, a tooltip exists that will refresh your memory on the various features and capabilities of the simulation. The last functional area we'll be discussing is the finance department. Every corporation requires capital, cash, to pay its bills. This is the responsibility of the finance department. And in the simulation, that is exactly what they are there and tasked to do, to ensure that there is sufficient working capital in the corporation to meet the demands of the corporation itself. And as you can see from the screen that's being displayed, we have a pro forma cash flow. Now this cash flow is not 100% exact because of a number of different elements. First of all, we're not sure if the projected revenues that are shown are going to actually be met. They are mere projections. Also, the efficiency of the marketing and operational department, the effectiveness of salaries based on corporate loyalty isn't an exact number. It is a relativistic number, if you will. These numbers will be close. The biggest area of concern, obviously, is the projection. The other element to understand, there is a country risk. And going back to the economic parameters, a finance manager needs to be aware of the country risk associated with the country, the potential that the corporation could lose all of its assets. But basically, the items in green that you see on this cash flow are, if you will, inflows, cash coming in, and the items in the red color are the outflows. For example, the pro forma corporate tax. It is merely an estimate. We're not sure exactly what the profit is going to be in the corporation in the respective country, but we can estimate based on the projections that we see. So the finance manager is working from these pro formas and therefore has to take into consideration how confident they are in some of these numbers. Will these numbers require an additional conservative approach, and we may need to borrow money from commercial loans to handle it or issue bonds? Or are we quite comfortable with the numbers we see and take a much, much more open view? The first area for us to, if you will, receive capital and to spend it is commercial loans and commercial bonds. And so we have a cap, a limit that we can borrow over the period of the simulation. We have a limit in the number of bonds that can be issued over the period of the simulation. In addition to that, we have the two expenses, FDI and inventory. The FDI expense is a preset number that is required to ensure that the investment is made, and the value defaults to 5,000 but can be changed by your faculty, by your instructor. So therefore, it's important to understand what is the minimum required investment for FDI. In addition to that, you have an investment in inventory storage. Now, commercial loans and corporate bonds are only valid in domestic and FDI countries. Inventory storage is obviously valid for domestic, FDI, and export. And it's important that an investment be made in inventory storage because if there is excess inventory, then what will happen is that inventory will be scrapped. Now, as you notice, what the screen just showed us is the system will prevent you from exceeding the constraints that have been placed by your instructor on the various parameters. So the first aspect is cash sources and usage. And so the finance manager has to determine if they wish to borrow commercially, if they wish to issue bonds if allowed, how much they wish to spend as a minimum, and beyond that in terms of FDI, and how much they wish to spend in terms of procuring inventory storage facilities in the respective countries that they're selling products. The second source, if you will, of capital, looking at the cash flow, and now you have made your decisions and you sit there, the second source you now can go to is in terms of selling stock. Again, you can only sell shares of stock in the corporation in countries in which you are doing business as domestic or FDI. You cannot do so in export countries. In addition to selling shares of stock at the stock price that's been designated in local currency, you can also issue dividends per share. Again, dividends should be issued only if there is sufficient cash in bank to cover the expense associated with issuing these dividends. So the finance manager going through the available sources, can then have a, if you will, an equity source where they can issue shares of stock in a country to raise additional capital. And they will proceed to do that, as well as the associated dividend. The third characteristic, the third aspect of the finance manager's area of responsibility is in terms of the transfer of funds between one country and another, between one business unit and another business unit. If you are transferring funds between countries that have the same currency, for example, in this case here, we see that the Finland and Greece have the same euro currency. Well, in that case, there is no exchange rate. However, if there is a difference transferring from the United States, for example, to Finland, or the United States to the UK, then an exchange rate will take effect. In addition to that, repatriation of funds, if you'll notice the very last line of the screen, indicates how much in terms of capital transfer is allowed by that country. And again, this is a variable number. This will be discussed as a range. And so the key behind it may not necessarily be that number, but it will limit you. So you have to be very, very careful, because you may be in a country where it's very difficult to repatriate funds. So therefore, if you're making a considerable amount of profit, you will not be able to transfer that money into, as you can see on the screen, you will not be able to transfer that money from country A to country B. You'll be limited based on the repatriation. So these are the elements and aspects associated with the finance department. So another source is within the corporation itself, which is this currency transfer screen. The finance manager can move money from country A to country B, from business unit A to business unit B in the same country. And again, the key is, depending upon the fact, is it common currency? Are they different currencies? Exchange rates and repatriation, if you're dealing with different countries, will take effect. The objective of the finance manager is to ensure that there is sufficient working capital in the corporation so that they can effectively run the company. And the idea is, where are these sources of capital? Commercial banks, issuance of bonds, obviously revenues, transfer from one business unit to another business unit, and so on. The idea behind it is manage the capital of the corporation itself. And if you look at the economic parameters, you'll see, for example, here is a definition of the currency exchange that will take place. As always, notice the tooltips with the asterisk. And for example, repatriation talks about the limitation of transferring from one country to another. So the idea behind it is, look at the various functional areas of your corporation: products, marketing, HR, and finance, and these represent the decisions that are made on an annual basis.